Um, Usually when you hear about a $53 billion investment portfolio, there's this expectation of massive architectural complexity.
Right, like a modern skyscraper or something like that.
Exactly. You picture thousands of intercepting steel beams, countless safety redundancies, shock absorbers for economic earthquakes.
Yeah, the standard industry playbook, hundreds of positions.
Right. And they point to a spreadsheet and say, look at all these fail-safes. But stepping into the world of Sir Christopher Hohns and his firm, TCI Fund Management, that blueprint is just, well, it's completely torn up.
It really is.
We're looking at a $53.65 billion portfolio that is, frankly, shocking. 9 stocks.
Yeah, just 9.
Just 9 core U.S.-listed holdings, making up almost the entirety of his disclosed equity exposure. I mean, he makes Warren Buffett's Berkshire Hathaway look hopelessly over-diversified.
He really does, yeah.
So today, our mission for you, the listener, is to decode the architecture behind this kind of alpha. We're examining the mind, the methodology, and the 2026 portfolio of Chris Hohns.
It's a fascinating deep dive.
But before we get into exactly how an investor sleeps at night with $53 billion balanced on just 9 steel beams, I want to share a quick note with you. To access more advanced researches, applications, and our latest published personal intelligent multi-agent deep value intelligence, welcome to explore and join deepvalues.ai community. Track total market temperature, welcome to search and download iOS app Buffett Indicator from Apple App Store.
Nice.
Okay, let's unpack this. 9 companies.
Okay.
How does a portfolio like that survive, a single bad earnings season, let alone a global economic shock?
Well, it survives because of a relentless, uncompromising filter.
A filter.
Yeah. It all comes down to Hans' core philosophy, which is the pursuit of what he calls monopoly assets.
Monopoly asset.
Right. He is not there looking for cheap stocks in the traditional bargain bin sense, and he's definitely not looking for turnaround stories.
So what's the actual target then?
He's looking for quality value. And, in his dictionary, quality means a business with a barrier to entry so high that it's virtually insurmountable.
Coupled with massive pricing power, right?
Exactly. The goal isn't to spread your bets to avoid losing. The goal is to find the extremely rare bets that are structurally impossible to lose over, say, a 20 or 30-year horizon.
Okay, so we're essentially looking at the filter he uses to find these 9 golden tickets. I think he calls it his quality list, right?
Yeah, the famous quality list.
But reading through his approach, something immediately jumps out that feels, counterintuitive. He prioritizes the moat, the defense, over the growth rate.
He absolutely does.
He would actually prefer to hold a slow-growing company with a widening moat over a fast-growing, highly disruptive tech startup.
Yeah, which surprises a lot of people.
Right, and I have to challenge that right out of the gate. We're living in a fast-moving 2026 economy. Tech cycles are brutal. Isn't a slow-growing business a terrible idea?
Well,
It feels like buying a beautiful, heavily fortified castle, but the castle is slowly sinking into a swamp. Sure, the walls are high, but the ground is giving way.
I see why you'd think that. But that visual is missing the central pillar of Hans' entire strategy, which is pricing power.
Okay.
What's fascinating here is he doesn't view pricing power as just a nice bonus. He views it as the ultimate inflation hedge and the absolute bedrock beneath that castle.
So how does the math on that work?
Let's look at his internal leveraged pricing model, because the math is actually pretty wild. Let's say you have a business with a 20% profit margin.
Okay, 20%. So for every $100 they take in, they keep 20.
Right. Now, if that business has true monopoly pricing power, it can raise its prices by just 1% above the rate of inflation.
And people just accept it.
Yeah, because it's a monopoly. It can do that without losing any customers or adding any extra overhead costs.
Wow. Okay.
When that happens, its profits don't just grow by 1%. They grow approximately 5% faster than its revenue.
Wait, let me make sure I'm following the math there. A tiny 1% price hike translates into 5% faster profit growth.
Yes, because that price increase drops straight to the bottom line.
Oh, because there are no marginal costs.
Exactly. There are no associated marginal costs to raising a price on a computer screen or a contract. This is the very definition of a toll bridge asset.
It's a toll bridge.
You own the bridge, you raise the toll by a few cents, and because people literally have no other way to cross the river to conduct global commerce, they pay it.
Right.
Your costs to sweep and maintain the bridge haven't changed at all, but your profit jumps exponentially. So your castle isn't sinking into a swamp.
It's sitting right on top of the trade route.
Directly on top of the only vital trade route in the hemisphere.
Okay, the math makes total sense when you frame it like that. The toll bridge. Let's shift gears and look at what these toll bridges actually look like out in the wild. Let's do it. Because TCI's portfolio has some massive heavy industry holdings that fit this perfectly.
It does, yeah.
The largest holding, anchoring the entire portfolio at 27.28%, which is over $14.6 billion, is GE Aerospace.
Right, a massive position.
Following its corporate spinoff, it's now a pure-play commercial aircraft engine manufacturer. And the operating margin here is staggering. It's sitting at 18.74%.
Which is phenomenal. I mean, it absolutely crushes the aerospace industry median, which hovers around 7.6%.
Wow, so more than double.
Oh, yeah. And the reason GE can command that kind of outsized margin is that they have perfected the ultimate physical razor and blade model.
The jet engine is the razor.
Exactly. Once GE sells an engine and it's physically bolted onto an Airbus or Boeing airframe, they have effectively locked that airline into a proprietary ecosystem.
For what, a few years?
For the next 25 to 30 years, it's maintenance, service, and spare parts.
It's basically the old printer model. You buy a cheap printer and then you realize you're forced to buy their specific, highly priced brand of ink for the rest of your life.
That is a perfect way to look at it.
Except in this case, the printer costs tens of millions of dollars, it flies at 30,000 feet, and lives depend on the ink.
Yeah, the switching costs are astronomically high.
Yeah.
An airline can't just casually swap a GE engine for a Rolls-Royce engine without completely recertifying the aircraft.
Right, retraining mechanics, grounding the plane.
Exactly. The technological complexity required to even try to compete in this market requires billions of dollars in R&D and decades of safety testing.
So that's the moat.
That is the moat. Even if GE's initial return on capital looks modest right now because of all the reinvestment they had to do post-spinoff, Han doesn't care.
He's looking at the long game.
He's looking at the predictable, high-margin owner earnings that will be generated by that service tail all the way into the 2050s.
But let's be real. Physical toll bridges aren't always bulletproof. The real world gets messy.
Very true.
Let's look at the rail sector, because TCI made a massive, highly visible tactical shift here. They recently slashed their position in Canadian National Rail, or CNI, by an aggressive 47.52%.
They practically cut it in half, yeah.
At the same time, they maintained a huge position in Canadian Pacific Kansas City, or CPKC. But this is what confuses me.
What's that?
CNI is famously the only tri-coastal railway in North America. They connect the Atlantic, the Pacific, and the Gulf of Mexico.
They do.
If the whole game is about owning a geographic monopoly, why in the world is Han dumping the ultimate geographic monopoly?
Well, because having a monopoly on the map is useless if the toll collector is asleep in the booth.
Okay.
CNI was struggling with a severely worsening operating ratio. It had hit 64.2%.
Hold on. For those of us who don't run a rail yard, what does operating ratio actually mean in this context?
It's basically the primary metric for railway efficiency. It simply measures operating expenses as a percentage of revenue.
So a lower number is better.
Exactly. If your ratio is 64%, it means you're spending 64 cents to make a dollar. CNI was getting bogged down.
By what, specifically?
Winter conditions were wrecking their schedules, operating expenses were climbing, and their efficiency was declining relative to their peers.
So Han realized that it's not enough to just own the tracks.
Right, you actually have to run the trains well.
So the physical moat was intact, but the execution was failing. The bridge was fundamentally congested.
Precisely. Now look at the company he kept, CPKC.
Okay.
They have a different, and right now, a vastly more valuable geographic monopoly. They offer a seamless, single-line network.
Oh, right, stretching straight from Canada down through the U.S. Midwest and deep into Mexico.
Yeah, hitting major ports like Lázaro Cárdenas.
And this is where the macroeconomic picture ties in, right? Because of nearshoring.
Yes, that is the critical insight here. With global supply chains rewiring, massive amounts of manufacturing are moving out of China and into Mexico.
And CPKC captures that.
CPKC is the only single-line rail network positioned to capture that specific north-south flow. There is no border friction.
What do you mean by no border friction?
They don't have to change crews. They don't have to swap locomotives at the border. This structural advantage gives them an industry-leading 55.5% EBITDA margin.
Which is just a measure of core operating profitability.
Exactly. And they are actively stealing market share from long-haul trucking.
Because trucking is getting crushed by fuel costs and driver shortages.
Yeah. Han looked at the map and reevaluated which physical toll bridge is actually capturing the traffic of the 2026 economy.
So physical bridges are great, but they still require steel, diesel, and maintenance crews. Is there a version of this where the bridge costs practically nothing to maintain?
Oh, absolutely.
Because looking at his portfolio, as much as Han likes a physical railway, he seems heavily tilted toward digital toll bridges.
He definitely is.
Here, the moats aren't built out of concrete. They're built on network effects, massive data scale, and regulatory mandates. Let's start with Visa.
Yeah, Visa.
It makes up 18.12% of its portfolio. That is nearly $10 billion in a single credit card processor.
Yeah.
And it operates with a 67.05% operating margin. That doesn't even sound like a real business metric.
I know it sounds made up, but it's the result of being the quintessential global digital toll bridge. Think about the network effect.
Right.
Every single new merchant that accepts Visa makes the card slightly more valuable to you and me.
And every new consumer who puts a Visa card in their digital wallet makes it mandatory for a merchant to accept it, or they lose the sale.
Exactly. It is a closed, virtuous cycle that creates an unchallenged global duopoly with MasterCard.
Wow.
Once Visa built that massive processing infrastructure, the marginal cost of handling one additional transaction is practically zero.
Which brings us to a term that TCI uses constantly in their analysis, return on invested capital, or ROIC.
ROIC, right.
Visa's is sitting at an absurd 29.89%. But for the listener who isn't staring at a Bloomberg terminal every day, what does a 29% ROIC actually mean in plain English?
It's actually a very simple, elegant concept. It just means that for every single dollar Visa pours back into its own business to grow, it generates roughly 30 cents in pure structural profit year after year.
That's credible.
Try getting a 30% guaranteed yield on a factory expansion or a savings account. It's impossible for most businesses.
It is a money printing machine. Now, let's look at a different kind of digital moat. He has a combined 24% of the portfolio locked up in the financial information oligopoly.
Moody's and S&P Global.
Right. And these aren't consumer brands like Visa.
No, but they're arguably even more powerful. I like to think of them not as toll bridges, but as the bouncers at the most exclusive financial club in the world.
I love that analogy.
They operate as a duopoly that serves as the de facto judiciary of global capital markets. They have a legal moat.
Right. They are designated as nationally recognized statistical rating organizations, or NRSROs.
Exactly.
So it's a government-mandated moat. If a massive corporation or a municipality wants to issue debt to sell bonds to the public, they are essentially forced to pay Moody's or S&P for a credit rating.
They have to. If they don't get that stamp of approval, institutional investors simply won't touch their bonds.
And they will have to pay infinitely higher interest rates.
Yep. The fee they pay to S&P pays for itself instantly. It's a toll you are mandated to cross. S&P Global's operating margin expanded to nearly 52% recently.
Because it's just data.
Right, these are incredibly capital-light businesses. Their only real inputs are smart analysts and proprietary data that is deeply embedded into the daily workflows of every major bank on Earth.
Which brings us to the ultimate digital toll bridges and the elephant in the room. Big tech. Microsoft and Alphabet.
Yes.
Microsoft is a 15.13% stake, rocking a 46.8% operating margin. But here is the massive logical gap I need you to explain.
Okay, let's hear it.
So what does this all mean? How can Han be so confident that Microsoft and Alphabet's moats are safe? We are deep into the AI revolution. Generative AI is fundamentally rewriting the rules of software, search, and enterprise tech every few months.
It really is.
Entire industries are being disrupted. How does he know these specific digital castles won't just evaporate overnight when someone builds a better AI model?
It is the most important question in tech investing right now. TCI's confidence stems from the realization that AI is not a disruptive threat to Microsoft. It is a massive fortification of their existing moat.
How so?
It comes down to distribution and ecosystem integration. Microsoft's integration into global corporate workflows is absolute.
You mean through things like Office 365, Teams, and Windows?
Exactly.
Yeah.
The cost, the logistical nightmare, and the security risk for a Fortune 500 enterprise to rip out Office 365 and switch to a competitor is prohibitive.
Right, you don't just change email providers.
No, you change the entire operational nervous system of the company. Microsoft doesn't need to have the absolute best AI model in a vacuum.
Because they have OpenAI anyway.
Right. Because of their partnership with OpenAI, they can seamlessly layer a vertically optimized AI stack across an audience of hundreds of millions of captive enterprise users.
And distribute the AI through the moat they already built.
Exactly. Alphabet is doing the exact same thing with its massive pre-existing distribution pipelines through Android and the Chrome browser.
Oh, and Alphabet has that massive $462 billion cloud backlog, too.
Yeah, that backlog is a huge indicator of locked-in future revenue.
Okay, the switching costs protect them.
Sure.
The distribution network is more valuable than the underlying AI model itself. I buy that.
But if we connect this to the bigger picture, TCI also loves these companies, and Visa because of the concept they call the cannibal.
The cannibal. What exactly is a cannibal in high finance?
This is crucial to understanding how TCI supercharges their returns. They look for companies that generate so much free cash flow that they can't possibly reinvest it all into the business.
Okay.
So they use that cash to become cannibals. They aggressively buy back their own shares on the open market and retire them.
The share buyback. It sounds like financial engineering. Let's ground this.
Yeah.
How does buying back stock actually benefit the investor holding the shares?
Think of the company's total value as an 8-slice pizza.
Okay. An 8-slice pizza.
You own one slice. If the company takes its extra cash and buys 2 slices back from other people at the table and just throws those slices away, the pizza is now only 6 slices.
Oh, I see.
But the overall size of the pizza pan hasn't changed. By default, your single slice just grew to represent a much larger percentage of the total pie.
Wow.
Visa, S&P Global, Microsoft, they're buying back stock at massive rates. By constantly reducing the total number of shares, they're artificially increasing the remaining shareholders' slice of the profits.
So they don't even need massive external revenue growth if they are mathematically shrinking the share count every single quarter.
Exactly.
You buy the toll bridge, you raise the toll by 1%, and then use that extra cash to slowly buy out the other owners of the bridge.
Yeah.
It is a brilliant self-feeding loop.
It really is.
But what happens when the kings inside these economic castles get lazy?
That's a huge risk.
Or when they get wasteful with that cash? This brings us to a highly unique part of TCI's strategy.
Activism.
Right. Han doesn't just passively hold these 9 stocks and hope the CEOs do the right thing. He uses clinical corporate activism to protect his investments.
He absolutely does.
For instance, he used very public, heavy-handed arm twisting to force Alphabet to cut its headcount
Yeah, that was a big deal.
and to rein in its massive $180 to $190 billion capital expenditure AI arms race. He demanded they focus on actual returns in their experimental other bets divisions, rather than just chasing growth at any cost.
He views activism as essential maintenance. You know, many institutional investors shy away from activism.
Why is that?
They worry about career risk or getting bad publicity or causing friction with corporate boards. But Han sees it as a primary tool for value maximization.
So he gets his hands dirty.
He is essentially the ruthless maintenance man for his own economic castles, enforcing strict capital discipline.
Right. And it's not just about traditional cost cutting. Here's where it gets really interesting.
Okay.
There's his Say on Climate initiative. TCI uses its voting power to force massive corporations to publicly disclose their greenhouse gas emissions.
Which is pretty unusual for a hedge fund.
Yeah, and submit detailed carbon reduction plans to shareholder votes. And on top of that, Han originally set up TCI with an automatic formula to donate a significant percentage of its assets and outsized returns to his own charity.
The Children's Investment Fund Foundation, or CIF.
Right, which has grown into a $6 billion endowment.
Yeah.
But let me push back hard here.
Sure, go ahead.
On one hand, you have a clinical, ruthless capitalist who forces tech giants to execute mass layoffs to protect his margins. But on the other hand, he forces climate change votes and gives billions to a children's charity.
Yeah.
Isn't that a massive fundamental contradiction in his strategy?
Well, this raises an important question about the nature of incentives. On the surface, it looks like a contradiction, but if you look at the mechanics, it makes perfect sense.
How so?
First, let's address the climate activism. This is not some warm and fuzzy social crusade. To Han, this is hardcore clinical financial risk management.
Financial risk management.
Yeah. TCI's portfolio turnover rate is incredibly low. He holds these stocks for decades. He views climate change through the lens of what he calls stranded assets.
Stranded assets.
Yeah.
Meaning assets that become financially worthless because the world moved on.
Exactly. If you are holding a heavy industrial company or a railway for 30 years and their management is completely ignoring the global energy transition, what happens?
They get hit with taxes.
Right. They are eventually going to get hit with massive regulatory penalties, carbon taxes, and significantly higher costs of capital.
I see.
Demanding peak financial efficiency today and demanding rigorous climate risk management for tomorrow are the exact same thing. Both are just ways to maximize the survival and the cash flow of a business over a multi-decade horizon.
So it's not about being green, it's about making sure the asset doesn't get regulated out of existence by 2050.
Precisely.
And the charity, CFF.
The charity was designed as an internal incentive mechanism. By directly tying a portion of his fund's performance to a philanthropic engine, he created a psychological structure.
A structure that forces him to perform.
Exactly. It forces him to be ruthless, to demand excellence, and to generate pure alpha. The better he performs as a capitalist, the more the foundation scales.
It all comes back to the architecture of the castle. You don't just build high walls,
Mhm.
you make absolutely sure the ground underneath it is solid enough to hold the weight for the next 30 years.
Perfectly said.
So let's synthesize this. What are the ultimate lessons for you, the listener, from unpacking this $53 billion nine-stock portfolio? First, extreme concentration is the ultimate shield against bad ideas.
Yeah, it really is.
When you only allow yourself 9 slots in a portfolio, you simply cannot afford to put a mediocre speculative company in one of them. It forces absolute, unshakable conviction.
Totally.
Second, structural durability always trumps fast growth. A slow-growing, highly defensible toll bridge will mathematically outlast a fast-growing, vulnerable tech fad every single time.
And finally, recognize what the most powerful assets in the world actually look like. They are structural monopolies. Whether it is the physical 30-year lock-in of a GE jet engine, the government mandate of an S&P credit rating, or the zero marginal cost network ubiquity of Visa.
Think back to our opening image. That idea of a $53 billion skyscraper balanced precariously on just 9 steel beams. It sounds terrifying until you realize that those 9 beams are forged from the strongest monopolies on Earth.
Which leaves you with this final thought to ponder. If you were forced to put your entire life savings into just one single toll bridge company today, and you were locked out of your account and couldn't touch it for 10 years, which company actually has a moat wide enough and pricing power strong enough to survive the next decade of disruption?
Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for educational and research purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions. If you'd like to access wider topics, including life investing philosophy, please subscribe to our sister channel, Deep Values. Don't forget to like this video. Much appreciated.